Hi, it's Paul Seabridge here. I just thought I'd record a very quick video just explaining how sometimes we may use a corporate bond as a way to acquire a business. So, bonds can be used as a way to acquire a business, and the way that it works is that we would issue on completion as consideration to acquire the shares of a business a corporate bond, and the corporate bond is issued by a public company listed on a stock exchange in Europe, and it is a listed bond. So similarly to how stocks and shares can be traded, bonds can be traded in a similar fashion. So bonds normally are issued for a 5-year term, and the bond after 5 years, when it matures, is paid out in full by the public company. The bond over that period of time, that term, attracts an interest rate. At the time of recording this video, interest rates vary, but typically will be between 2 and 5%. So if you use an example of a £1 million bond attracting a 5% interest rate, then over 5 years, that bond is worth 1.25 million, 250 grand in interest payments, and of course the actual value of the bond itself is £1 million, so added together is 1.25 million. Now, you can, when you trade bonds, you can of course turn those bonds into cash. So you could either choose as a business owner selling your business and accepting a bond as consideration for your shares. You could either retain that bond, you could earn the interest over that period of time, and at the end you'll receive that full amount. But if you wanted to turn it into cash, there's a mechanism to be able to do that. So I guess the first question to ask is, when you're selling a business and you're looking to exit, what you're actually going to use that cash for. If you don't need that cash and you were just looking to cash in and put the money in the bank, or you didn't have any major purchases that you wanted to spend it on, then it actually might be better to consider retaining the bond or some of the bond rather than turning it into cash, because a bond attracting a 5% interest rate in the current economic circumstances that we see ourselves in, particularly pre-COVID-19, actually a 5% return on investment is much better than you would get by putting the money in the bank. But let's just talk about how you turn those bonds into cash if that's something that you would want to do. So firstly, because these are traded bonds, they're traded on a stock exchange. Who buys these bonds? Well, typically it's pension funds, regulated financial institutions, investment buyers, corporate buyers. They're the sorts of typical buyers of bonds. And the reason that they will buy them is because that they're basically buying future cash flow. They're buying that interest rate return. And in some cases, they're buying those bonds at a discount to their face value. So if they acquire a bond for less than its face value, of course, then immediately they make a return on that cash. So there is what's called a period of seasoning. And it's, I guess, to use a slightly different analogy, it's very similar to how you build a credit rating when you turn 18 and you get your first credit card. It takes a while to build up your credit rating. And the way a bond works is probably can be described as being quite similar. So when a new bond is issued and the bond has no track record, and what institutions and buyers of these bonds are typically interested in the most is how strong the person that's issuing the bond is in terms of being able to meet those interest rate payments. So normally the bonds that are issued that we work with typically attract an interest every 6 months. So when a new bond is issued, the bond has no track record regardless of how good the issuing entity is that's issued the bond. But after we've made an interest payment after 6 months, 12 months, 18 months, the bond becomes more seasoned. The institution can see that interest is being serviced when it's supposed to be, and when it becomes more seasoned, then the ability to sell them becomes easier, but also the discount that you may need to offer to somebody to buy as an incentive to buy these bonds becomes less and less because it's become more seasoned. So to use a specific example, if you were issued with a bond today, let's say it's £1 million bond, and you wanted to, cash all of that in one job lot straight away, very quickly, almost fire sale prices, then you would typically expect to have to discount that bond by 30%. So on £1 million bond, you could turn it into cash for 700, and the institution that buys it for 700, they give you the 700,000, but then they become the owner of that bond for 5 years, and then when it matures in 5 years' time, they receive the full value of it, £1,000,000, but they also earn the interest along the way, 250 grand over 5 years. So their 700 that they've given to you, they actually make in total 1.25, which is a profit of 550 grand in that example. But that's if you want to cash the lot in all on day one. If you're willing to trade these bonds gradually and sell them over time, then you won't need to discount as much, because there are a number of institutions, and some will want to buy for a 30% discount, and there'll be others that have an appetite to buy for 15. But maybe the one that wants to buy at 30% is because they have much deeper pockets and will want to buy many tens of millions of bonds, whereas smaller funds might only have an appetite to buy, £500,000 a month, for example. So if you're willing to sell them off over a period of time, then you won't need to discount perhaps as much. But as the bond becomes more seasoned, so let's say you hold the bond for 18 months, there will have then been 3 interest payments made over that period of time. The bond becomes more seasoned, and it's likely that you would only need to discount by 5 or 8%. So using that £1,000,000 example, in 18 months' time, potentially you could sell that for a 5% discount. So you would net 950 grand, and the institution that would buy the bond would still earn that, 1 million plus the remaining interest payments over a period of time. So whilst their return is less, they feel more confident in the issue of the bond, because 3 interest payments have been made. So that's how the bonds work in terms of how we use them as consideration to buy a business, but also how they can be turned into cash.